Good evening. Welcome to STC's educational webinar. This is a Q&A session with some introductory information. I'm Jackie Knight. I'm the Corporate Training Director for STC, and we're very happy to have you join us this evening. Before I get started, I do want to mention a few things about STC. We are a retirement plan administrator only, so we are not permitted to legal, tax, or investment advice. We are not a registered investment advisor. We don't represent or sell securities or investments of any kind. We don't represent or endorse any investment opportunities. I may talk about some during this presentation as examples, but we don't represent or endorse any investment opportunities. We do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. This evening's webinar is primarily a Q&A webinar, but I am going to start by giving some basic information about self-directed retirement accounts. I'm also going to talk a bit about investment options, guidelines that must be followed in all retirement account investing, the retirement account structure that we use at STC for each of our clients' accounts, that's an LLC structure, and the services that we offer. And then I'll go into the Q&A section where I will answer the questions that you have typed into me. So first off, let's talk about what we mean when we use the terminology self-directed retirement plan. When we use that term, we mean that you have a plan with an administrator or custodian that permits you to choose any type of asset that is permitted by law, anything the IRS rules and guidelines allow. And that would include what some would consider as non-traditional assets like real estate. So anything that is permitted by the rules and the regulations are permitted in a self-directed retirement account. This also means that you, the retirement account owner, manage the retirement plan's investments. So let's say that you choose to have own a piece of real estate in your retirement account. Then you would be the one that would decide how you were going to dispose of that real estate, if you were going to rent it, what the rental rate would be. If at some point you decided your retirement account was going to sell that, what the selling price would be, you would make the decisions related to all the investments that you hold in a self-directed account. It is truly self-directed. Now this means that you have control over the decisions that relate to the investments that you hold in your retirement account. And that is what many folks are looking for when they are looking to grow their retirement account assets. They want to be in control of those assets. Perhaps they have some particular area of investing expertise that they would like to take advantage of in their retirement account. And with a self-directed account, you can do that. So that's what we mean when we say self-directed retirement plan. Now there are lots of different types of plans, and they can all be self-directed depending on who you hold them with. You have probably heard of traditional IRAs and Roth IRAs. They're similar with one very important distinction. They both have the same maximum annual contributions. For 2016, that is $5,500 from your earned income. If you are 50 years or older, you can contribute a maximum of $6,500 from your earned income. The difference being a traditional IRA contributions are pre-tax. You don't pay tax on those contributions, but when you begin taking distributions, once you reach retirement age, those qualified distributions are taxable, and you include them in your income in the year that you take the distribution. Roth is a little bit different. Your contributions are post-tax. You pay taxes on the amounts you contribute to a Roth account. However, when you take qualified distributions after reaching age 59 and a half from a Roth, those distributions are not included in your income, and they are not taxable. So that's a big difference between the two, and if you want some more information about the differences, you can go to our website and look at different descriptions of retirement plans or ask me a question. A SEP plan is a simplified employee pension plan, Sometimes small business owners or sole proprietors might use this type of plan. It does permit larger contributions. You can make contributions as the employer and the employee of a business. You do have to have a business in order to have this type of plan, and the earnings from the business are what are you can charitable organizations or nonprofit organizations. TSA is a tax-sheltered annuity, and TSP is a thrift savings plan. If you formerly worked for an employer and participated in one of those types of plans, and you no longer work for them, then you can roll the monies out of those plans and transfer them into a self-directed account that you qualify for, a traditional IRA or a SEP if you have a business. So you can move the monies out of those accounts into a new account that can be self-directed. If you have monies with several different employers, you could consolidate all of those monies into a single account as long as they are like kind of money. You can't combine Roth money with traditional money because that's pre and post tax. You actually have to go through a conversion process if you want to change traditional money into Roth money. But you can consolidate like money accounts. Another type of plan is a 401k plan. You may currently be employed and participating in a 401k plan. You would need to go to your plan administrator at your employer's office and ask them if you are permitted to self-direct any of the portion of the monies that you have in that plan, or if you are permitted to roll monies out of that plan into a new plan that you could set up with a self-directed administrator. So if you are currently employed and participating in a 401k plan, you do need to go to your plan administrator to get some guidance on what you might be able to do. Now, with a self-directed retirement plan, you have very many investment options. You can invest in real estate. I already mentioned real estate, and that does include lots of different kinds of real estate, single or multifamily homes, vacation investment property, tax liens, raw land and building lots, even commercial buildings, or real estate syndications where you group together with others to invest in a real estate purchase. Now, I do want to mention a couple of things here. There are rules that do have to be followed, and where I have vacation investment property, I just want to highlight that one because you cannot personally use any vacation investment property that is owned by your retirement account. It violates one of the rules that I'm going to tell you about in a moment. So you do have to be cautious about the use of the real estate, but you certainly can invest in real estate in a self-directed retirement account. You also can invest in mortgages, and you can make loans from your retirement account to a borrower, and then your retirement account becomes the lender, and the borrower would repay your retirement account with interest on this loan that you have set the terms up for. So you certainly can do that. You can also invest in private business investments, certain precious metals. There are some definite guidelines about investing in precious metals, but they certainly can be held in a retirement account. You just need to make sure you're following the guidelines. You can invest in the foreign currency, the Forex market, options, futures, and of course you can have stocks, bonds, and mutual funds in your self-directed retirement account. So having a self-directed account really opens the door to a wide range of investments in your retirement account. Now, as I mentioned, there are guidelines that must be followed for all retirement account investing, whether it's a self-directed account or not. These are rules that have been established by the IRS or the Department of Labor, the ERISA rules. And the first one I'm going to talk about is prohibited assets. There are some types of assets that you may not own in a retirement account. And the first one of those is a life insurance contract. That is not a permissible asset in a retirement account. Another non-prohibited asset is collectibles. Things like rugs, works of art, stamps, a stamp collection, a coin collection. The IRS has very specific guidelines that define which collectibles are not permitted in a retirement account. But in general, collectibles are not considered a valid retirement account investment. In addition to prohibited assets, there are transactions that are not permitted. Your retirement account is given some tax benefits. The earnings in your retirement account are tax deferred. You're not taxed on them in the year that they're earned. Rather, the taxes are deferred until you begin taking qualified distributions. So that's a benefit to you of having a retirement account. You don't have to pay taxes on the earnings in that account. But the account its purpose is to benefit you at retirement. So you do need to be engaging in transactions that are for the exclusive benefit of the retirement plan. You cannot personally borrow from your retirement plan, and you cannot pledge your retirement plan assets to secure a personal loan. They can't be security for a loan that you are getting personally. That is a prohibited transaction. You also cannot utilize your personal credit or your personal guarantee to get a loan for your retirement account. Now, let me just elaborate on that a little bit. Your retirement account can borrow money to purchase a piece of real estate. But to do that, it must be a certain type of loan. It must be a non-recourse loan, which means that the lender, if there's a default on the loan, only has recourse to the property that the loan is on. So there's no recourse to any other assets in your retirement account. There's no recourse to you personally or your personal assets, only the property that the loan is on. That's a non-recourse loan. So you can't personally go out and get a loan for your retirement account to purchase a property. That is a prohibited transaction. Your retirement account can use a loan, but it has to be a non-recourse loan, not a personally guaranteed loan. You also cannot benefit any disqualified person with a transaction in your retirement account. So let's talk a little bit about who are disqualified persons. And you'll see that the first person I bring up on the screen is you. You and your retirement account are two different entities. And your retirement account cannot do a direct transaction with you personally. That will violate this rule. There are other family members who are also disqualified persons. And I should mention that if you are married, your spouse is also a disqualified person to your retirement account. And other certain family members. Ascendants, so that would be parents, grandparents, great-grandparents on up the line. Descendants, so that's children, grandchildren, great-grandchildren on down the line, and are also disqualified persons. Now, lateral family members are not disqualified. So brothers and sisters, aunts and uncles, first, second, 12th cousins, they are not disqualified persons. So you can keep that in mind. If your brother owned a particular property or your aunt owned a particular property, your retirement account could purchase that property from them. But if you own it or your spouse owns it, no, your retirement account cannot purchase it from them. Now, there are two entities or entity types that are also disqualified persons. to your retirement account. Any company, if you are a majority shareholder of that company, and any company, if you are an officer, a director, or a highly compensated employee, HCE. If either of those is true, your retirement account cannot do a direct transaction with those companies. I oftentimes have real estate investors in my audience who perhaps do real estate investing through a company, and they are the majority or the whole owner of that company, and they wonder if a property that they own in that company can be purchased by their retirement account. And the answer is no, if they are the majority shareholder, or if they're an officer or director or a highly compensated employee of that company. So that is something you are not permitted to do. Now I'm going to tell you a little bit about partnering in a moment, which is a little bit different. And there are some things that you can do, but these are the basic guidelines and rules relating to disqualified persons. Now at STC, we use a particular type of account setup for each of our clients' accounts. We use an LLC structure. And this is a very specific type of LLC. It's not a generic business LLC. It has been set up for the sole purpose of being owned by a retirement account. So it has specialized operating agreements and articles of organization. And it becomes the investing vehicle for your retirement account. All of the assets that you own will be titled in the name of the LLC. Now we use this structure because we believe it has a number of benefits that really make self-direction more straightforward and simple and more flexible for our clients. It does give you maximum flexibility in structuring complex transactions. Many clients come to us because they have multiple parties to a transaction. Perhaps they're going to use leverage. They're going to get a non-recourse loan for a transaction. So if you have complex transactions, the LLC structure can help facilitate them. It does provide an additional layer of asset protection because it is a limited liability company. This structure also gives you checkbook control over your retirement funds, so you have immediate response to investment opportunities. We know that good investments, they can come and go pretty quickly, so you need to be able to move on them. You don't want your paperwork sitting on somebody's desk waiting for it to be approved. So what we do is, you'll notice I have checkbook control in quotes. We do not give our clients the checkbook for their retirement account. Some companies do, we do not. And we do that purposefully. We don't want to put our clients in a potentially precarious position where they might possibly engage in a prohibited transaction, because the penalties for doing that can be severe, up to even forfeiting your retirement account. So you don't want to put yourself in that position. So instead, what we do is we offer what I call protected checkbook control. You send your documents to us. We look them over. Our experts review them. If there are any questions about whether something might be prohibited or disqualified, we get in touch with you before we send the funds to the seller. You make all the decisions, but we review your investments to make sure that they are not disqualified or prohibited transactions. So you have protected checkbook control. Using this structure also simplifies asset titling. As I mentioned, it's the investing vehicle for your retirement account. So all of your assets in your retirement account are going to be titled in this LLC's name. It does also ease pooling. And what I mean by pooling is partnering with other funding sources. So I'm going to tell you that even though I said you cannot do direct transactions with yourself, your spouse, your parents, your children, you can partner with those people at the inception of a transaction and co-own an investment. And we have many folks come to us, sometimes spouses, sometimes parents and children, who want to co-invest in an investment. As long as that co-investment takes place at the inception of the transaction, then that can be an allowable transaction. I want to show you a picture of what that might look like. So this is a little schematic of our retirement plan structure with the LLC. You'll see on the upper left you have the current custodian. That would be if you have a plan now and you decide you want to open an account with us. Documents would be filled out and signed directing your current custodian to transfer or roll over the funds to our self-directed custodian. We would create this LLC in the state of your choice, and once the monies were at the self-directed custodian, another document would be executed directing the custodian to purchase all of the ownership of this LLC with all of the money in your retirement account. So then the money in your retirement account moves to a bank account that your LLC has access to, and now you're ready to invest. So in this scenario, your LLC retirement account wholly owns investments 1 and 2. We don't know what they are. They could be a piece of real estate, could be a loan to someone. Investment 3, however, has 4 co-owners. 1 is your retirement plan, 1 is your father, 1 is your daughter, and 1 is some of your personal money. These 3, ascendant, descendant, and you personally, would normally be disqualified persons. But as long as you co-invest at the inception of the purchase transaction of investment number 3, this is permissible. This is a permissible transaction. So we help our clients make sure that this kind of a transaction is documented and engaged in properly so that it does not violate the rules and is okay for the retirement plan. So we do have lots of folks who like to do that type of transaction. Now, before I go to the questions, again, please do type questions into the question box on your screen. I do want to run through the services that we offer, and then we will go to the questions. We are a full-service administrator, so we fulfill all of the things I'm going to list here. We set up the retirement account LLC structure. We offer that protected checkbook control I described for you. We have CPAs and attorneys to answer your technical questions, and they're available to you as much as you need them. We offer unlimited guidance on transaction compliance, all the back office support. So that means we maintain the financial statements for your retirement account, all of the money's in, all the money's out, proper recording of all the transactions. We supervise the regulatory reporting that's required, and we oversee the annual valuation for your retirement account. It has to be done every year to the IRS. So we do all of those things so that you can focus on finding the best investments for your retirement account, and you can make the decisions that relate to those investments. Now, that is the information that I wanted to share with you as introductory. Now we're going to go to the questions and answers. And I did receive some in advance, and it looks like I am getting some questions here as well. So if you will give me a moment to open up my question box. And again, go ahead and type in anything as it comes to your mind. Okay. Okay, the first question I have is, what is the time frame to get my account up and running with STC? Okay, because we do the LLC structure setup, it does take some time to initially get your account set up. Typically, it takes 4 to 6 weeks from the time the original paperwork is received at our corporate office to have your account set up complete. During that time, we will be coordinating the transfer of your assets from your current custodian to our new custodian. We'll be creating that LLC I told you about, and we do keep you informed of the progress via email. And then once the funding of your new account is complete, then we send you a confirmation email. We also send you a binder with copies of all of your account documents and instructions for making future contributions and for funding transactions. So once that initial setup is complete, then you really have same day or next business day funding of your transactions. And I'll just go ahead and explain that because that's often a question. Let's say now your account setup is complete and you are ready to invest and you have found an investment. Then in order to complete that, you will simply fax documents to our corporate office. We have a transfer of funds form. You'll complete that form, you'll sign that, you'll attach any supporting documents that are necessary. You fax those to our corporate office. Our client services department reviews same day all those transactions that come in and review them. And if we receive those documents and everything's okay with them, if we receive them by 2 p.m. Eastern time, we can fund that transaction the same day. We can use an ACH payment and get that those monies from your retirement account to the seller of the investment. If the documents come after 2 p.m., then it would be the next business day. If there are any questions about the documents, if we have a question about who are the parties, could this possibly be a prohibited transaction, we will get in touch with you right away and sort that out. And if something needs to be changed, then we'll talk with you about what would need to happen. So I'll just take that question. So initial setup does take some time. Once the setup is complete, then we can do same day or next business day funding of a transaction. Okay. If I have a rental property in my account, who does the renter send their rent check to? Okay, now that really kind of depends on if you're using a property manager or not. We do recommend that you use a property manager for realty that you are holding and renting in your retirement account, just to ensure that you don't violate any of the prohibited disqualified person rules. So typically when you use a property manager, they collect the rent, the checks are made payable to them, and then they forward to your IRA LLC the excess funds, anything that's above their fee or any expenditures. Now if you're not using a property manager, then the checks would be made payable to your IRA LLC and they'd be mailed to our office generally. They could be mailed to you, but then you'd have to mail it to our office, so it's just an extra step before it would get into your retirement account. So you would just need to work that out, and you can talk through that with our client services department. Okay, so that is who the check would be. I'm sorry, I'm getting lots of questions in here. Okay. If I want to put IRA money into a self-managed stock brokerage account, can I? Can I actively trade in that with IRA funds? Yes, yes, you can. There is no prohibition against doing that. You can open a brokerage account with any company that you choose. Now, you will need to talk with that company about their requirements. The account must be opened as a business account in the name of your IRA LLC. So it's going to have that LLC name on it. It's not going to say IRA account number for the benefit of. It's going to have your LLC name on it. And what we ask is that you send us copies of your monthly statements, because we need to ensure that you haven't made any deposits or withdrawals from that account personally. Because if you do, that would be considered contributions and distributions, and those have consequences. So that would need to run through us if you are adding money to that account or withdrawing money from that account. So you can do it. You would want to talk to our customer services department again about exactly how to set that up, and we would help you walk through that process. Okay. I received a question in advance that I'm going to ask if the individual is on the line to please elaborate. It says, does the enabling rule still apply? If you could please illuminate me as to what you believe the enabling rule to be, then I will do my best to answer that. I think I have an idea, but I want to be sure I know what you're asking. Okay. Could the LLC obtain a loan from a banking institution to finance an investment such as commercial property? And the answer is yes, absolutely it can. This LLC that we set up for your retirement account is the entity that would be getting the loan. Again, it would need to be a non-recourse loan, and there are a number of lenders out there who are now making loans to retirement accounts. So you can go out and do some research and find those folks. And then you would talk to them about their requirements. But yes, absolutely, the LLC can get a loan. You have to go to the banking institution and find out what their requirements are. Okay. Oh, I'm looking down a bit at that question. I think I see what the person is asking. Back to that enabling rule, they added an IE, which I think is, for example, can one combine personal money and IRA, 401k money to fund an investment? You can't combine money. I'm going to just say you can't put money together in one pot, but what you can do is your retirement account, and you personally can go to the seller of an investment, and at the inception of that purchase, each of you can buy a portion of that investment. So you are co-owners from the very inception. And one thing about that, that stipulation is that once you've done that, the ownership percentages of that transaction can never change. So let's say you have personal money and your retirement account has money, and you pool or partner your monies together and go to a seller. And let's say you personally pay 60% of that purchase price, and your retirement account pays 40%. You must always remain 60-40% owners. Every bill the payment on that loan, if there's a loan, everything related to that property, all the expenses have to be paid 60-40. All the income is divided 60-40. You can never change those percentages. So that is something that we would talk to you about. If you wanted to do that kind of a transaction, you would want to talk to client services about, okay, what does this mean? Because it does limit you in the future, so you do want to take that into consideration. Okay. Okay, I want to start investing in real estate, but I don't have enough in my IRA to buy a property outright. Do I have any other options? Well, the couple that I've just been talking about, your retirement account could borrow funds to complete that purchase, a non-recourse loan. You could leverage it. I'm going to come back to that in a moment. And you could also partner with somebody else's funds and co-own it. And you wouldn't be the sole owner then, you would be a co-owner. But if you have an investing colleague who might be interested in doing that with you, or you have some personal funds, or a family member, as long as that, if it's a disqualified person, just has to be done at the beginning of this transaction. I do want to mention something about using leverage to purchase a real estate transaction, because using leverage in most retirement accounts is going to trigger something called unrelated debt financed income, which has a tax consequence. So if you are using a non-recourse loan to leverage a purchase in your retirement account, you do want to do some research on UDFI, Unrelated Debt Financed Income. I do have a previously recorded webinar, I believe it's called Advanced Insights, that talks a little bit about UDFI. And I'd encourage you to look into that. And certainly if you are our client and you are going to leverage a purchase, please do talk to client services, and they can help you understand that, and then you can go to your tax accountant and get more details on that. Okay. Okay, a traditional IRA requires the owner to begin withdrawals at age 70, actually age 70 and a half. The year you turn age 70 and a half, you must begin taking minimum distributions. It's called required minimum distributions, RMD. And the question is, if I own real estate in my account, am I required to sell it in order to begin taking those distributions, I guess is the question. And then there's a second question, which I'm going to read in a moment. Okay, so let's say you reached age 70 and a half this year, and you're required to take a minimum distribution, but looking at that calculation, you have insufficient cash to take as a distribution. Do you have to sell the property? The answer is no, you don't have to. What you can do is you can actually have an appraisal done of that property, and then you can distribute as your required minimum distribution a portion of the ownership of that property to yourself personally, which would mean retitling the property. Now there would be two owners of the property, your retirement account and you. So there would be a retitling required, valuation and a retitling. If that happened to be a rental property, then that means now that rental income is split between your retirement account and you personally based on your proportionate ownership of that property. So it can be done. You're not required to sell the property. You can distribute it to yourself. Now, there was a second part of this question. If income from the property exceeds the allowable contribution, how is that handled? Okay, first let me say there's a difference between amounts that you contribute into an account and amounts that are earned by the investments in the account. Your investments can earn as much as they can earn. There's no limitation on the amount of earnings your investments in a retirement account can earn. What you're limited is the amount of the amount of contribution that you can put into an account. And that's limited by law, and it's limited based on the type of account you have. So for example, a traditional IRA, your maximum annual contribution for 2016 is $5,500 from your earned income. If you're 50 years or older, then you can add an additional $1,000, $6,500. But your contributions are limited, but your earnings are not limited. So just to make sure you understand the difference between those. Okay. Okay, this relates to loans and lending. Does STC choose the terms of my loans? So this is somebody who must be thinking about lending to a borrower for monies in the retirement account. No, the answer is no. This we don't stipulate any terms for the loan. This is truly self-direction. You are making the loan. Now, you'll choose the terms of the loan. What we will do is we will make you aware if any of the terms of the loan you're setting up might raise a red flag in an IRS audit. You know, so let me just give you an example. If you're loaning money for 5 years at 1% interest, that's kind of questionable. The goal of the IRA is to increase in value. Remember, you're supposed to be engaging in transactions for the benefit of your IRA. The IRS would probably wonder why you made a loan at such a low rate when typically borrowers can't get that kind of rate from another lender. So we won't tell you what the rate needs to be, but we would inform you that those terms might be raising a red flag to the IRS, and they could be placing your IRA at risk. So just keep that in mind. We'll let you know, but you will make the terms of the loan. See, I got a few questions here all at once. Okay, this is a good add-on question. Does a loan I make from my IRA have to be secured? In other words, do I need to have collateral security on this loan? No, it's not required. The IRS does not require you to have your loan secured. However, your IRA's investment is more protected if it is secured. And so if you do have security collateral on this loan, you want to make sure that in addition to having that collateral listed in the note document, you want to make sure that a lien is recorded on that property. You don't want to assume that that was happening. You'll need to go out and, on behalf of your retirement account, have a lien recorded on that property that's securing the loan from your retirement account. Okay. Are custodial groups such as yourself restricted to handling accounts within a limited region, or do you handle accounts nationwide? Yes, we do. No, we're not restricted. We do handle accounts throughout the United States. The last I checked, I think we had account owners in over 40 states. So we're all over the country. By the way, we are headquartered in Hagerstown, Maryland. If I want to purchase a bank-owned house, they often require verification of funds. Okay, how would I verify funds that are in my self-directed IRA? Very simple. You contact our client services department. We can give you a proof of funds letter. It's a special form letter, and what we would ask is that you call us or send us an email, and we'll prepare that letter, and we'll email it to you within 24 business hours. Now, what we do want to know is what amount you want us to put in that letter. You know, we can put up to the full amount that's in your retirement account or anything less than that. And you may not want that letter to say the full amount in your retirement account, especially if you might be bidding on a property and you may want to bid $90,000, but you have $200,000 in your account. You may want that proof of funds letter to say $90,000, not $200,000. So we'll ask you the amount up to the total value in your account that you want on that proof of funds letter. Do I have to pay taxes on the income that is generated by my IRA? Generally, the answer is no, you don't. There are some exceptions, and that would be the one that I've already mentioned. If you have a recourse loan to purchase property, then UDFI, unrelated debt financed income, may come into play. There are also some cases when an account might have taxes on its income from investing in an active operating business. So then what could be triggered is UBIT, unrelated business income tax. The IRS has decided that IRA accounts are similar to nonprofit charitable organizations, and so UBIT, UBIT, can be applied to some transactions. It's pretty rare. Most of the investments that you will do in a retirement account are passive and generate passive income, so there would not be taxes, but there are some rare instances. So you will want to check into that if you're investing in an operating business or if you're using leverage to buy real estate. You could trigger taxes in your retirement account. Okay, I am considering a Roth conversion. Should I do that prior to transferring or rolling the funds over to you? If so, are there additional fees associated with the conversion? You can certainly do the conversion wherever you like. A couple of things to mention. If you are converting to a Roth, there will be tax consequences because remember, non-Roth contributions are pre-tax, Roth contributions are post-tax. So you're putting monies into a Roth account, so you're going to have to pay taxes on those monies. You can certainly transfer it at your current custodian, or you can move the money first to us into a traditional account, and then we can convert it for you. We do not have any additional fees to convert. You would have to check with your current custodian to see if they have conversion fees or not. But you can certainly transfer to us and then convert at no conversion fee with us. Can I decide to roll over a portion of my 401k, corporate 401k, to a self-directed retirement account? Oh, okay. I'm not sure what the second half. I'll just answer the first part. If you're still employed by the company that sponsors that 401k plan, probably not. There are some rare exceptions. On some occasions, there are 401k plans that contain provisions that allow you to roll over a part of your 401k to an IRA while you're still employed. It's also possible that the plan administrator might allow you to self-direct your 401k funds. So we would recommend that you contact your HR department or your plan administrator to get more information about this. Now, I did have another question. I want to make sure. Let me look that up again. I had a question about multiple rollovers in 1 year. Let's see. Okay, here it is. Actually, I have a few more questions now. Can you make maximum contributions to both a regular or traditional and a Roth IRA in the same year? No, you cannot. They're limited. That $5,500 or $6,500 is the total amount. You can split it between two accounts, or you can lump it in and put it all in one account, but you can't put $5,500 into a traditional and $5,500 into a Roth in the same calendar year. Okay, can the account holder and the spouse's limited partnership co-invest at inception, be a qualified transaction? With just that amount of information, I would say yes, that sounds like you could. We would, of course, want to see the actual partnership, LLC, spouses LLC partnership documents, just to make sure. But as long as it's the inception of the transaction, that likely would be permissible. Okay, another well, this is actually kind of a statement. If I understand this correctly, I can purchase a lot or property with the funds from my LLC. She means a retirement account, I guess, a retirement account LLC, and then I can sell that property and hold the mortgage for the new buyer within the LLC. That should be a doable transaction. The thing to consider is who the new buyer is. Can't be a disqualified person. But if it's an unrelated party, you should be able to do that, and then the retirement account holds the mortgage on that sold property. I mentioned that you could combine multiple accounts into a single account. I think that's probably where this question came from. So all current IRA CDs, 401k IRAs can be rolled over to self-directed. Yeah, I don't know about a 401k. That you'd have to go to your corporate plan. But yes, you can move monies from traditional Roth into a self-directed account with us. And then they say, I read that you can only roll over once per year. Is that per account? There was a new ruling, I think it was in 2014 or 2015, that now only one 60-day rollover can be done per year, all your accounts in aggregate. Now, let me just define what a 60-day rollover is. That is when the amount is distributed from a retirement account to the IRA owner, and then the IRA owner deposits that money into an IRA within 60 days. You can only do that one time per year. And I think it's a rolling year. It's a 12-month period. It's not a calendar year. But you can transfer, let's say you have monies in an old 401k that you don't work there anymore. You can move part of that money to us, and then 3 months from now, you can move another part of that money directly to us, from custodian to custodian. It's only when you take the money as a distribution and then you redeposit it, that's what can only be done once a year. So just keep that in mind. This person is asking, what are some better investments for smaller funds? Again, we can't recommend any investments particularly. I can say that sometimes tax liens are smaller in dollar value. Tax liens, lending money, doing private notes, those could be any amount that you have in your account if somebody would like to borrow that. And partnering with others sometimes works if you have a smaller account. Okay, a couple more questions that I had in advance. Please, I'm getting close to ending my time here, so just a minute or two left. So please type me any last questions that you have. Are beneficiaries permitted in the LLC? This LLC, remember, this is the investing entity for your retirement account. So the beneficiaries aren't attached to the LLC, rather they are attached to the actual retirement account. So you can and probably want to list beneficiaries on your retirement account. And then they would, the LLC is owned by the retirement account. So that would cover the LLC. Does the LLC have to be set up in my home state, or can it be set up in the state of security of STC? Actually, the LLC can be set up in any state you like. It sounds like this person is in California, and they have a high LLC fee. So they would prefer it not be in California. So it doesn't have to be in California. It doesn't have to be in the state you live in. We have registered agents in some states, so it can be in other states. And then it says California. If I live in, even if the LLC is set up in another state, if I live in California and I'm benefiting from the income, California requires that I pay taxes to the state. Is this something that if the LLC is set up out of state, would I have to pay that tax? Okay. First off, keep in mind your IRA doesn't pay taxes. It's a tax-deferred entity. So until you begin taking distributions, there wouldn't be a tax consequence. Unless, of course, you triggered UBIT and UDFI, and then that's a whole other topic. Okay, I already answered that one. Can you use retirement account to purchase a franchise? Let me say that I can't answer that specifically. You will need to check with the franchisor and see what their requirements might be. What I can say is that if your retirement account does invest in a franchise, you cannot be, your spouse, your ascendants, your descendants, or any entity that you're a majority owner can't be actively involved in that franchise. So you couldn't work there, you couldn't manage it, you couldn't keep the books for it. So you want to keep that in mind. Are there any issues transferring funds back out of the account and later transferring back? No, I'm going to assume transferring means you're moving to a different custodian and then maybe you want to transfer back. Nope, you can do that. Now, a transfer is different than a distribution. A transfer is, or a rollover is moving money to a new account or a new custodian or back into an account that you already have open. A distribution is when you are taking money out of the account for your personal use. And when you take a distribution, then it is taxable. If you're 59 and a half or older and it's not a Roth account, it's taxable. And if you're not 59 and a half, then it also incurs a penalty. So you will want to keep that in mind. Folks, I am going to need to end our webinar tonight. Thank you so much for calling in and participating. Let me just mention that we do have a monthly webinar, and the next webinar is scheduled for Tuesday, June 14th. And that will be same time, 7 p.m. Eastern Time. So please do join us for that. If you got an invitation to this webinar, you will get an invitation to that one as well. And you can also register on our website. So thank you so much for joining us. We would love to assist you with your retirement account. So please do let us know how we can do that. If you want to open an account, or you have clients or colleagues who might be interested in self-direction, or you need more information, you can contact your STC representative. If you don't know who that is, you can contact me. My email and phone are on our website. And you can also check out our website at stcira.com, and there's our corporate phone number. So please do get in touch with us and let us know how we can assist you. Thank you so much for joining us this evening. Good night, everyone.